Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to be using. It has been a good year for the indices, all of them up double-digit percentage gains, but what about your portfolio or your 401k? Should you be trying to keep pace with those big gains? And what is a good return? And with the end of the year, is there anything you should be doing with your holdings? It's coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial experts and advisors, and they are Carrie Coghill of Coghill Investment Strategies. Next, we find Frank Rossetti. Frank has his own alternative management company, or investment company, I should say, HF Management Company. Also sitting at the table is Kim Forrest of Boca Capital Partners. Usually seated at the table is Michael Godwin, but Michael could not be with us today. So let's go ahead and get into this. As we head into the last 10 days or so of trading in the stock markets, it has been a good year for the indices. The NASDAQ is up 20%, the S&P 500 is up 16%, the Russell 2000 and the Dow are both up roughly 14%. Now, those are the indices, and they are weighted so that the larger capitalized stocks influence the indice more than a smaller one does. In other words, if a larger company goes up or down, that has a greater impact on that indice than a smaller one does. So my question, has the retail investor done as well as the indices in 2025? And Carrie, I'll start with you.
Yeah, it depends. You sound like a lawyer. It depends. It really depends on how people are allocated. And what I'll say is, for us who are in the business of really managing risk at the end of the day, most clients at this point they're more diversified. So we wouldn't expect them to be up as much as the index for two reasons. One is usually their portfolio isn't 100% invested in the stock market. But the second point is when we're diversifying a portfolio, we're not only owning everything that's highly weighted in technology. So when you look at the market, you really look at growth stocks, which are those, technology falls into that. But in order to create an all-weather portfolio, you also have to have value stocks. And those are your larger companies. A lot of times they pay dividends, which clients like. But when you're in an environment that's being driven by technology, that part of the index, the value part of it, isn't going to perform as much as, let's say, an overall S&P 500 index that is market weighted.
When I worked with clients, I tended to take the position that the indexes were not my benchmark. The client's need was my benchmark. We'd run calculations and determine what they needed to earn on their money in order for them to maintain the goals and objectives that they had in mind. And then we allocated accordingly. Therefore, the indexes, although we say how do we do against the indexes, it's really more important is how we did against our goal. Do we exceed our goal? Do we undershoot our goal? And for either one, why? Because the goal is the goal. Now, the market drives all this, and right now, as Carrie said so well, it's been driven by pretty much AI until recently. And so the facts are, did they do as well? The studies say this year that the individual investor has been more tuned into the market than the institutions, because the institutions would get a little risk averse because of the valuations of these AI type stocks, and they may be pulling chips off the table to reduce their risk out of fear. Whereas now I think that the media that's talking about the people that have been playing into the AI thing, I think that's more the Robin Hood investors, which is more akin to gambling than investing.
So it's been my experience. Well, let me start again. I think what Carrie and Frank are talking about is really important for people to understand, that you have a risk tolerance, and needs for your money. And this is the best thing that advisors do, is they match those up with the possibilities of where you can invest in the markets, right? So you're going to be allocated so much in small cap, so much in large cap, blah, 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 right? But it is so important to understand risk tolerance and returns. So all of that aside, the portfolios that we run are having a really great year, and that's with a sigh of relief. The last year, 2024, was the year of NVIDIA. And if you didn't have NVIDIA and in a large enough position, you were left behind, because NVIDIA truly was the thing that was driving the market. It was the sun of the investing universe. Everything revolved around it. And somewhere, I would say in like April-ish timeframe, things changed. And I guess that's the great, and I just figured it out. I'm talking, on the fly. That would be, the great tariff issue, right? Things came to this halt. The market dropped, but then people slowly got back in. And what I saw in the portfolios that I run, which does use the S&P 500 as its benchmark, is the smaller companies started to really grow, because they had been left for dead. And I don't know if it's institutions or if it was ordinary retail investors decided to take a look at these high quality companies and invest in them. And you can see that, and that's called breadth, right? Instead of the one stock being the successful thing, it has broadened out and there are more stocks. So I think, as a rule, probably investors have done pretty good this year. And if you're a momentum investor, you're a little confused, because you thought if you bought NVIDIA and held NVIDIA, you would rule for, from here on out. And that's not the case. And I think that's really a good lesson, that diversification is important. And 2024, you are not at all rewarded for diversification.
Yeah. And it
All
really
right,
does.
Go ahead, Carrie.
I was going to say, building on what Frank and Kim said, really for a client or for an investor, the key is risk tolerance.
Yep.
How much risk are you willing to take? And a lot of times, I know for us, when we talk about risk, we're really talking about volatility. How much fluctuation? Because I know that, the three of us sitting here, we're not investing in things that we think can go to zero.
Right.
So it's more about the roller coaster ride. At the end of the day, you get to where you're going, but how much can you really take along the way? Because the hardest part for us is that when you're going down that hill and people want to get out of the market, it's just like a roller coaster. You can't. If you do, you're going to get hurt. So, that really speaks to making sure that when you're buying something that is of good value, that has a strong balance sheet, that has cash flow. I always say that the market can be used for two things. You can use it to invest and you can use it to gamble. So you really have to understand that part of it and what you really can take going into it.
How much does age play a factor in how you decide what to invest in? Or how you invest, I should say.
Honestly, for us, it's not about the age, it's about the objectives, right? We have clients that will never touch their portfolio because they have other sources of income and they're really investing for their kids and their grandkids, versus someone who is living off the income of their portfolio. So age matters to the degree that it results in a change of your goals, as Frank said earlier.
The last question, after I've said everything Carrie said to a prospective client or a client, was I would finally nail it down by saying two different things. One, there is risk and there is risky. Risk goes up and down. Risky goes to zero. We don't want to go there. And then the last thing I would say, and how much of risk we take is a function of at what point will you lose sleep? Because I don't want to go there either. Because much to my wife's chagrin, I used to say, if what we've done caused you to wake up at 3 in the morning, feel free to call me. Now, in 52
How many
years,
calls did you get?
No one ever did in 52 years.
They waited until 4 o'clock in the morning.
So when I entered this industry in 1999, Larry Horan was the director of research, and he was my boss. And I was writing, instead of actually, placing trades in portfolios and making portfolios, I was only looking at companies and saying buy, sell, or hold. I was a sell-side analyst. That's what that's called. And it's funny. Larry was from New York, and we defined Parker Hunter, which is where I work, defined risk as volatility, right? And Larry, who was an economist, he had a PhD in econometrics, and so he's a math guy. And he's like, risk is you losing your money. Risk is not volatility. And he really fought and lost it because compliance got in the way, right? So, but that has always stuck with me. And I think if you really profoundly understand that you are an owner of a company, that is what you're doing. Like, I essentially trade contracts, right? That I'm an owner of Coca-Cola, I'm an owner of Microsoft, one of many, but still a small slice. And if I look at the value of my portfolio and say, oh, that's at risk, Microsoft went down $10 today, I couldn't do my job. So I think I have a very different risk tolerance because I know profoundly what I own. And I know Microsoft or Coca-Cola or whoever is, if I'm doing my job right, I've reduced the risk because I understand the company.
All right, I'm going to kind of wrap this up and go back to the original question, sort of, and that is, all right, let's just say the S&P, the NASDAQ is up 20%. S&P, as I think I said, was up 16% so far. The other two up 14%. I understand that investing in smaller capital stocks, which is probably why we saw the Russell 2000 set a new all-time high for that indice last week, as did the S&P 500. And I understand totally, Frank, what you're saying. You're looking at goals, but as an investor, as I sit at home and I take a look at 2025 and I see that those have gone up that percentage, what should I expect then? I mean, I know it depends on what you hold and how you're diversified, but you do like to have some idea of just whether you're keeping pace or not. Am I right or wrong?
When
I
you
guess.
talk about the investor sitting at home, you're right. What the investor forgot was what we did at the very beginning. Because I know Carrie does this, and I know we do this, and I did this. We lay out an investment plan, which this is what we're going to do, and these are the risks we're going to take, and this is why we're going to do it. And when my investors would call me and say, the market's up 10% and we're only up 8 or 6 or whatever it was, I would say, I know, and there's a good reason for that. Let's look at what we decided at the beginning. Maybe we should sit down and review your objectives, but let's talk about why we are where we are, which made this happen. And this is what we agreed was right for you then. And I know that we review objectives. I know David, my son, is still reviewing objectives with people every time the market moves a lot, and once a year, whichever comes first. And when the market moves a lot, down or up, people either get excited and they want to go whole hog because they become momentum players, and we have to remind them where they lose sleep. And it's a constant process that never ends because of what you said, Stacy. I'm sitting at home and I did not keep pace. Or They never say the market's up 8 and we're up 16. They never are upset about that. I get nervous when that happens, and the reason is that means I probably took risk I didn't think I was taking.
Yeah.
All right, and we have to measure it differently. Now I'm exaggerating to make the point, but when we outperform, I start wondering, did we take risk we didn't intend to take, and is that why it happened? And I'm sure, Carrie, you do the same thing.
So, yes, for sure. It's interesting when we're monitoring performance of accounts, we're looking at underperformance and overperformance because outperformance can actually mean you're holding too much risk. However, Stacy, I love your question because I think it's really important. And I think it's really important for clients to have a benchmark. Yes, their goals are a benchmark, but that doesn't necessarily, it does answer the question, how is your advisor doing? If you've set out for a certain return, but the client is always going to question, yeah, I get that, but could I have done better? So accountability is really important, and we want to give clients confidence that the decisions that we're making are working. So the way that we do that, like Kim had mentioned, her benchmark is the S&P 500. When we're creating benchmarks for our clients, we're looking at what their overall allocation is on two levels. How much they have in stocks and how much they have in bonds. And then we'll even break it down further into large cap, mid cap, small cap, growth and value. So, there are different indexes out there you can use to gauge. I will say that normally, if you're just looking at your breakdown of stocks to bonds, growth to value, you're going to be able to get a pretty good sense of the actual investment selection and if it's delivering relative to other options within that space. So, it's a mistake to compare everything to the S&P 500. And that's where you have to do a little bit more work if you want to have a benchmark that's more reflective of the goals that you're trying to achieve.
I suppose the opposite is true. I'm sorry, Kim. I suppose the opposite is true too. If the market goes down and your client's portfolio goes down a little bit more, you're going to hear that phone ringing as well.
Yeah, for sure.
Right. And here, let me give my opinion, because Carrie's somebody that evaluates people's performance like myself. And, she's looking at what the benchmark is and does the portfolio, because she understands not only companies, but also managers and how they think. And when she selects a manager, she's doing it for trying to find the right manager for the slot she has in the big puzzle that is a client's assets, right? So I'm only part of it. But really, I am keenly aware of where the portfolio is, and is it, my style of investing should, for many reasons, be able to beat the S&P by a couple of percentage less fees year after year. That is what my goal is to do. And that means by going up more, but it also means by not going down as far as the S&P when it falls in a year, like it did in 2022. So managers like myself are trying to put together portfolios that then work for real people, right? And Carrie has to solve this whole, it really is like a jigsaw puzzle that she is trying to put those managers with the risk tolerance of her clients. So I hope that highlights the difference of how you use benchmarks differently in different applications.
And the puzzle that Kim's referring to is what we call that is portfolio optimization. How much of a certain category, large cap growth, small cap value, bonds, etc., how much of each of those, when you put it all together, has the ability to deliver the results, as Frank mentioned, that you're looking for with the risk tolerance that is aligned with the client. So, this is where sometimes clients get hung up because it is a puzzle. And if you take one piece out, you lose your picture. I often refer to it like baking a cake. There are ingredients and there might be like baking soda is essential in baking this cake, but you would never just own it on your own. So sometimes people come to us and they're like, okay, I see everything I own, but this isn't doing well. And that might be the baking soda that's going to save you when the markets fluctuate.
All right. This has been a good discussion so far, and I kind of want to play off this as to, I think, what Frank indicated, that at least once a year, you take a look at your goals and where you stand and what you should do. So as we head into the last 2 weeks of this trading year of 2025, what should an investor be looking to do, if anything, with his or her portfolio, especially since we're talking about, everybody uses a benchmark of a year, and we all like to start with January the 1st. So is there a plan that you start to take at January 1? And I use that also because that ends, December 31 ends the tax year. I don't know if I'm making any sense with this question or not, but right now, whether they're your client or somebody else's client, what should they be looking to do, if anything?
Well, it always comes back. I think the big thing about the end of the year is that it comes back to what are you doing to manage your taxes? And that process of getting there. So there are a lot of things people can do, whether it's, tax loss harvesting, getting in there for the last time during the year to capture losses if you have them. And there are very methodical ways of doing that. Or whether it's gifting money out or, because people can gift up to $19,000 a year to, anyone and everyone that they want. And if you're wanting to reduce the size of your state to avoid estate taxes, it's something really good to do. You might consider gifting to charity, or if you're in a large tax year, gifting to a donor advised fund where you can kind of front load your deduction, but not have to give the money until you're ready. So you make those decisions as to what tools you want to employ. And then you can really look at the portfolio and say, what is my best strategy? Do I gift appreciated stock to a charity so that I don't have to pay a capital gain on it versus taking money out of cash and I'm still sitting on this capital gain? When it comes to taking and rebalancing the allocation of the portfolio, if growth has outperformed. So in an effort to rebalance back to my risk tolerance, do I take some of that gain before the end of the year and take more of it right after the first of the year to get me back into balance while the market's still at this level? So it really comes down to, what you need to be doing to keep your portfolio in balance and how you can strategize around that during this opportunity to potentially spread things out over 2 tax years. That's a real advantage.
As far as making major investment decisions because it's the end of the year, that's as good a time as July or May or September as far as I'm concerned. Investment decisions are made on an ongoing basis in most portfolios based on how the markets are treating what you've done. And people like Carrie and I used to, and Kim does in her portfolios, are constantly measuring what we own, why we own it, and should we continue to own it, and what we don't own, why we don't own it, and should we change that position. It's an ongoing, and the fact that Christmas is coming, quite frankly, is irrelevant.
Thanks, Frank. I love that you think that way because other than taxes, I agree with you. The market does what the market does, and that's because people are putting their dollars where they think they're going to grow the most. And I mean, that's institutional and retail investors alike. And the rollover of one day to another or 1 year to another means nothing. I really, really hate, I can't even tell you how much I hate this. The next couple of weeks, we're going to have like, what did the market do? I mean, this is in the press and on TV, financial news. What did the market do and what's it going to do next year? Next year's the year for energy. Next year's the year for pharmaceuticals. All this nonsense. We don't know. We know when you can see patterns forming underneath, and they happen all the time at weird times. And as a manager of other people's money, that's my job to be noticing that, like what is going on with the market. But 2025, 2026 doesn't really matter to me.
Well, what
Yeah.
is going on with the market? So give us what's the underlying thing you feel right now? I'm sorry, I can't resist that.
That's okay. I think one of the biggest things is they really want AI to work. They really want the Jetsons to happen in their lives. I don't know that that's going to happen, and I know it's not going to play out the way everybody thinks. And you can see some issues, we'll just say, in certain stocks. Like NVIDIA is struggling, and I don't know that it gets back to its, I'll make a really, really short-term thing here. I don't think it really goes much higher between now and the end of the year, and that's just because it's the next couple of weeks. Because there's not probably going to be news that reinforces one view or the other. But I think people have to be thoughtful of, is there a bubble, and where is that bubble, and where is it in my portfolio? That's what my biggest issue is. How about yours?
I'll give you mine. I think that AI eventually will be meaningful. I don't have any idea what eventually means. I think that NVIDIA probably as the first, what do they call it, the first adopter or whatever they are. And I think that they have had a wonderful run as a result of that, but now other people are starting to catch up. You've got big money players like Google and Amazon who are coming in, and they're going to compete with NVIDIA. And NVIDIA is going to have to sharpen their pencil to maintain their edge. And that is called capitalism. That's what happens every time. There's nothing new about it. And what we're seeing the markets doing, in my mind, is starting to diversify away from NVIDIA and one or two other first adopters, like maybe Microsoft, maybe. And they're starting to spread it out. It's starting to play into the small cap world because there's all these little guys that are up here who have a new widget that is going to work in AI, and maybe it will and maybe it won't. And that's what Kim does, try to figure out which ones have the best chance of actually doing something. And most of those companies aren't making any money, so it's really difficult to evaluate them. And for Carrie and people like me, who I really want to have a business that's actually a business, not an idea. And so, I'd rather pay more for the idea when it actually starts generating profits. But that's just me. Call me an old man and old-fashioned, but that's a fact for me. And consequently, and I know Carrie, I'll bet Carrie thinks exactly like that.
Yes, 100%. And the interesting thing is this feels so much like 1990, like it's probably 1998, right? Like everyone wanted the internet to work, and at what level, and technology, and we're starting to see it a little by little. Oracle's earnings that they reported, and oh, guess what? And we talked about this. I was with a client last week, referred to our show, where we talked about AI and can it deliver? And what does it look like? And what are companies doing to do it in a way that is ethical, etc. And I share Kim's sentiment. I mean, it's, what does it even look like? I don't even think people know what it looks like. But all these big investments that are being made, are they going to be able to deliver in a way that will sustain price? And I think we had a little bit of insight to that when Oracle reported their earnings. So you just have to be careful. And we've talked about this before. If there's a bubble, we're probably not even close to it popping, because bubbles usually don't pop until everyone's on board. And then when you start talking about, like, now people are going to small cap, that's even riskier. So you have to be very careful, and you have to own quality. And at the end of the day, valuations matter. Doesn't mean that good companies, good growing companies will always have higher valuations. But it gets to a point where, people will start justifying the astronomical valuations, and that's when you really have to be concerned.
We'll have to wrap this up, but it was interesting. I cannot remember which investment advisor or person who has his own company was quoted, I think, in the Wall Street Journal, and said about this bubble. He said it's not going to burst; it's just deflating, and so that was kind of an interesting take on it. I don't know if you guys would like that or not. We have had a great discussion. We're out of time already. Thank you so much for joining us. We'll continue our look at investing in the economy in our future editions. So we may or may not have another one before the end of the year. And since you're watching or listening to this podcast, I ask that you hit the like or the subscribe button on whatever platform you happen to be using. But for right now, thanks for joining us, and we'll see you again maybe in about 2 weeks or so. Thanks.